This podcast includes information provided by the issuer and does not express the views of the interviewer. This podcast may also include forward-looking statements by the issuer that involve certain risks and uncertainties to its business. Because forward-looking statements are subject to risks and uncertainties, the issuer's actual results could differ from those indicated in this podcast. Welcome to the Planet MicroCap podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. You can follow Planet MicroCap on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT, and you are listening to episode 68. If you have any questions or comments, please feel free to tweet at me or shoot me an email at rkraft@snnwire.com. And when you do get a chance, if you like what you hear, please rate and review Planet MicroCap on iTunes. It really helps provide feedback for me and spread the MicroCap message. For this episode, I spoke with Karl Douglas, Chief Investment Officer of PPMT Capital Advisors. Not only does Karl run a multifamily office advisory firm at PPMT, he also has been a regular contributing writer to the MicroCap Review Magazine and has unique insight covering the MicroCap space. In the spring 2018 issue of the magazine, we published this article titled Family Offices, What You Need to Know. Since we haven't really covered this topic in depth on the podcast, I thought this would be an interesting topic to cover and share with you all with the goal to learn as much as we can about family offices. Thank you again for tuning in to episode 68, and I would like to introduce Karl Douglas, Chief Investment Officer of PPMT Capital Advisors. Karl, welcome to the Planet MicroCap podcast.
Hey, Bobby. Thanks for having me. It's a pleasure.
It's great to have you on. And, as we always do here when we get started is let's get your background. How did you get started in the wide world of finance?
Oh, my goodness. All right. So we go all the way back to 1986. All right. Sometimes I wonder, should I really go that far back? Because people think maybe that's irrelevant, but the Dow was around 1700. I was at a company called Integrated Resources, which at the time was a Fortune 50 company that actually was an asset manager. Integrated Resources was very heavily involved in the real estate space. From there, I went to Salomon Brothers, and then from there, I went to Bear Stearns and spent a good part of my career at J.P. Morgan and also Merrill Lynch. And that takes us from 1986 all the way up to 2000, and I think that's probably a good framework to then, sort of transition and say, well, this is when microcap investing really started for me. I will say, though, my first microcap investment was a company called Automatics, which traded on the pink sheets, believe it or not, back in 1986, and we ended up, me and a group of guys, cornering the market on Automatics. I think we owned about 30% of it at one point. Great trade, and that always inspired my interest in the microcap sector.
So, Karl, just to quickly follow up on that, are you still currently a shareholder in Automatics?
No, I'm not a shareholder in Automatics at the present time. Mm-hmm. But my first real dive into the microcap sector was sort of as a private investment. I was involved in a venture capital raise for a company that we raised about $28 million for an internet technology, and had a very large opportunity to get capital in. 9/11 happened. A lot of the capital dried up around 9/11, and by the end of 2002, we ended up having to do a reverse merger. We raised a significant amount of capital. In Reg D rounds, in the private, in the merger, and then essentially exited into a private sale to another public company that was consolidating various technologies in 2003. So my first real foray into microcap was as CEO of a $300 million market cap company that traded on the OTC, along with all of the bells and whistles that you would imagine go along with that. But that was my start in microcap. So since then, I've been doing merchant banking investing, and did 7 deals between 2003 and I guess 2015. And in 2015, I started PPMT Capital Advisors as a multifamily office manager.
Mm-hmm. So for you, how do you then analyze a potential new microcap investment? You're coming more from the institutional side, but maybe use some of that retail experience as well. So maybe combine. Is it like a combined approach? How would you say it?
Well, a lot of people use basic buzzwords for how they go about it, but I would say that we're very much fundamental in terms of how we approach investments. First and foremost, we start with the balance sheet, understanding what the status of the company is, where they are in their development, and cash flow and balance sheet can tell you quite a bit about what's going on with the company. The second area that we focus on is management. We're very focused on management's track record and management's ability to execute the plan that they're basically, developing. So, give you an example. We've done a lot of work in energy and mining. In fact, since 2015, we've put out about 300, just over 300 million in capital in those types of investments. MicroCap, as you know, particularly with Canadian companies and others, very mining and energy centric. So, last couple of years we've invested in natural gas, also some of the shale oil development, and so we'll look first and foremost at what's happening with the company, look at the reserve reports, try to understand what the quality is of the PV10 reports that are available, or the JORC reports, or whatever particular report that they're looking at. Look at that very closely, and then we look at the balance sheet and cash flow and try to understand exactly what is going on. Is the plan sufficiently capitalized? Generally, in the microcap sector, we find that they're undercapitalized. It happens so often that a management team will acquire an asset, go into a public vehicle, and then rely on equity almost solely without really focusing on a comprehensive capital structure that allows them to get the asset into production. Mm-hmm. So we'll focus on that as well. And then management. I mean, with the market, having been so successful over the last couple of years, particularly in the energy sectors, you're seeing a lot of I guess the A team that's available out of energy resources in particular being hired by the majors, and so it's very challenging to find people in the field. That generally is one of the areas that we focus on. How strong is the management team?
Mm-hmm. So why? So have you always been interested in energy and mining sectors, or is that just you just started to focus on that in 2015 when you made that shift?
Our first energy investment actually predated PPMT Capital. It goes back to 2007. Mm-hmm. We invested. That was my first energy investment. It was very successful. We, took a number of small companies and essentially consolidated them and created a much larger company, which we ended up getting S&P rated, single B minus, and creating a really nice steady progression in terms of EBITDA growth. 2011, 12, and 13, respectively, we did 35, 37, and 38 million EBITDA in that particular deal. So, it was a deal that we, sort of really focused on fundamentals. We looked at, again, resource quality. We hired in management. We hired a top-rated CFO for the company, and we were lucky for a good period of the time of that company's cycle.
Mm-hmm. So how did you know then back in 2007 that you wanted to make that first investment into energy and then kind of shift that focus in 2015 to almost solely energy and mining? You know, what did you see in the markets that, changed that mindset for you?
That's a good question. It was the China effect. And in 2003, when I exited the first tech deal, I had a little bit of cash on hand and, and a lot of time. And I was basically investing in derivatives, oil derivatives, essentially, and made a lot of money. Oil went from $35 a barrel to $50. And, it's almost laughable considering it went well over 100, in subsequent years. But at 50, I started to get nervous and, basically pulled out, felt that I'd made enough. And I started looking for other areas to invest. And, so we basically, that's how I started end up doing the other energy deal. We invested in coal, which I've written about, quite a bit in terms of, what's happening with coal today. And in those days, going back 2007, it was on a nice run. So basically, I stepped out of oil, which was a derivative, and went into a direct investment in coal.
Mm-hmm. So now I'm going to divert a little bit because, you just wrote this article for the magazine that I'm going to get into in a second. But before I even get to that, I think this would be a good question to set the stage for it. What exactly do you do at PPMT Capital?
Well, we're a multifamily office manager. And what that means is in the family office space, you have essentially two types of family offices. You have single family offices, which is essentially just a family business generally gets formed. And that family business, as it accumulates cash and has the need to invest that cash, will start to look and act like essentially a small private equity type operation. And you have multifamily offices, which generally serve all sizes of family offices or family investors. But in general, the sort of 30 million of net worth up to, let's say, 250 million of net worth is sort of where multi-family office advisors add the most value, because once family offices get past that 250 million level, they start to achieve, size where they can, sort of bring on staff and start to professionalize in terms of how they operate. So family offices are range in size from, very small organizations all the way up to, companies like Wildcat Capital that is technically a family office that manages a couple of $1 billion. Mm-hmm. So that's basically what we do. Now, our focus is essentially we invest in 5 different areas. Obviously, mining and energy, we've covered a little bit of that. Infrastructure and industrials, food and agriculture. We also invest in manufacturing, and of course, real estate, which is sort of a staple component of family office investing.
Mm-hmm. All right, so you actually just touched on my next question a little bit, but maybe we get the full definition. Because we just published your article in the recent issue of the MicroCap Review titled "Family Offices: What You Need to Know." And so, for those who don't know, just give us your own Investopedia definition. What is a family office then?
So a family office is basically generally it's an evolution. Most families have a business that they run, whether that's an agriculture business or an industrial business, and so they accumulate a significant amount of wealth. And generally, what they do is start to originate investments, perform their own due diligence. They'll hire in investment professionals to conduct that due diligence, and they'll run their investments like a portfolio. And what that allows them to do is several different things. Number one, as families approach generational issues, it allows them to become very efficient in terms of how they hand off portions of wealth that the family generates to the subsequent generations. it also allows them to handle the issues that come about with that handoff of wealth and control of wealth. There have been some very good examples of multi-generational wealth management, and there have also been some, obviously throughout history, some very poor examples of multi-generational wealth management. But if you look at what typically happens, let's say you have 2 or 3 generations of a family alive at the same time. They're all, taking on their inheritance, rather than having to have everyone with different views, sort of chiming in and trying to manage, a single group of assets. That management is professionalized. It pays out dividends or distributions or whatever the mechanism is that the family chooses to the beneficiaries, rather than having hands-on direct, involvement. So, to put it very simply, Bobby, 30 years from now, when, your SNN empire is, generating huge wealth, and you've got all your kids and grandkids running around, instead of them all coming in and figuring out how to manage SNN's future, it's professionalized, and you just say, collect your dividend checks.
So, in the article too, you gave a little history as well. You talked about, the Medici family being one of the first, pseudo family offices. I mean, that would be kind of fun to talk a little bit about, some of that history that you covered.
Yeah, well, most of the articles that you'll read, they talk about the Rockefeller family and Standard Oil. But if you go back in history, family offices have existed in the West. The Medici family is one of the most profound and prolific Italian merchant banking families, actually. And they operated very much in that capacity, running what was essentially a family trade finance business as a professional business, and at one point became one of the most prolific financiers in Europe. You go back to ancient China, you had certain dynasties operating businesses in trade through the Silk Road in the same way as families, rather than being sort of professionalized corporations and bringing outside investors. They operated as one dynasty. So that's it's got a long history.
I feel like we could do just one episode on history of family offices. So, in the article also, you talk about how the number of family offices is growing, at such a fast pace. Why is that?
Well, there are a number of factors. It is I think the fastest growing sector of private capital, and there are a number of factors. Number one, the Madoff scandal actually caused a lot of families to really wake up. They were handing their capital off to, major financial institutions. And I think going through the combination of Madoff and the financial crisis of 2008, 2009, a lot of families didn't understand the risk exposure that they had. And so there has been a very, very strong trend toward, forming family organizations to do direct management, so that they're not in a blind pool of, private equity capital, for example. They are actually moving very fast and toward direct investments into every single asset that they own, and then they basically run it as their own portfolio.
Mm-hmm. And then, so this was one question that I've always had. Then, is what would you say is the difference then between family offices and, let's say, a hedge fund or an asset management firm?
That's a great question, and there are a number of differences. First of all, the family offices, for the most part, do not have outside capital. They're always investing capital that they've earned through other investments or through their own businesses, and basically, for that reason, there are a lot less outside influences. So they have a lot more flexibility in terms of what they can do. They're not driven by hurdle rates. They're not driven by predefined exits, to satisfy other investors, which generally makes family office capital long-term capital. Many of my clients, have willingness to stay in deals 7, 10 years and even longer. So that's relatively unheard of in professional money management. You will not find that in a hedge fund, and very, very rarely in a private equity fund, because they all have to exit at some point. Right. Family offices will, be perfectly comfortable buying a business or making an investment and owning that business for the long term.
Mm-hmm. And then also in the article, you mentioned that the family office ecosystem has its own protocols and language. Can you explain a little bit about that?
Yeah, definitely. So, with family offices, unlike, let's say, professional hedge funds or private equity funds, they don't usually have a formalized origination platform. So if you're going to a major private equity fund to, pitch a deal, they've got a set infrastructure whose job is generally just to, go through the markets and figure out, who the players are in a given sector, and they're paid essentially to listen to the story and understand and evaluate those investments. Family offices generally are small. The average family office is 10 to 15 people, and there's only so much origination that they can do. So what do you do in that scenario? Yet they get pounded with tremendous amounts of offers of investments, and so they rely principally on their trusted circle, right? Which generally is their accounting staff, or a lawyer, or close friends. And so getting into the getting efficiently into the family office ecosystem, to efficiently raise capital can sometimes be challenging, because you have to find out what the appropriate path is to a group. That's number one, generally. The second is that most of the people, particularly in sort of mid-sized family offices, Bobby, are, these are business people, right? They're used to sitting across the table, developing relationships, working with people to develop businesses, develop relationships over a period of years. The concept of, a pitch book coming in and, flip through the pages and, look at a couple of ratios and, make a quick investment decision, is generally not the way they invest. Family office investing is very, very much relationship investing. So, when we talk to people that ask us about how to approach family offices, we generally, say, do your homework, understand what their interests are, what businesses are they in, what investments have they made in the past, and, approach through, approach directly, which can be the best way, but try and get a meeting and have a quality conversation, and try to develop a relationship before you actually go in and start pitching a particular deal.
So I mean, are most family offices readily available, or do they have an online presence? Because I think most people hearing this will probably be like, well, then, all right, that's nice. Okay, I don't mind doing the more informal approach, but where's the network? Where do I find them?
There actually are a lot of growing networks of family offices of all sizes, and I can mention a few of them. If you're interested. And there are a lot of conferences nationally that where family offices are actually going out, and as they are increasingly professionalizing, they're going out and attending these conferences and actively, pressing the flesh and trying to meet, CEOs and intermediaries that have potential to present transactions, and that's a great way to do it, face to face, and those conferences allow you to do that.
Right.
There's a few organizations out there. One of the most active ones, which I think they are a family office themselves, is the Wilson Family Office out of Florida, and Richard Wilson's done a very good job building a network. He's opened, created access for a lot of families and companies to, essentially meet at, a whole series of conferences throughout the country. So it's very effective.
Mm-hmm. So I actually want to get back on your point about this, the formalized origination platform and how there's not, it's very informal, so to speak. It's not really a formal one. It's more on that, like, you happen to meet this one person through this person, it's a lot of relationship building, so in the family office ecosystem in this space, I mean, is some type of thesis created so that at least when they do come across something that fits that, they're able to dissect it a little bit further? Or, I mean, it just seems very much catch if catch can, luck of the draw type of thing, I mean, how is it done? Like, for instance, with what you do, I don't know. Maybe we could get a little bit more detailed on that, because it seems just so like diamond in the rough, luck of the draw type situation.
Well, that's a good question, and the one thing about the family office space is that it really is varied, Bobby. So you have every situation from like I said, a Wildcat Capital that is like walking into an Apollo, right? I mean, they're a sophisticated organization. The founder comes out of banking, so basically the whole thing is a very professionalized private equity operation, down to, the $30 million, sort of high net worth, smaller family office where, they basically they're just stepping away from, sort of packaged product managed money, right? And starting out. And so the characteristics of that size family can be very much like just dealing with a high net worth investor. Mm-hmm. So, you find all range. Now, the key word that you mentioned is origination. We believe that, quality origination is probably the most important component to achieving, returns. And there are a lot of characteristics that go into origination. And a big part of that is the thesis. And so you will find family offices they'll come out and say, we're value investors and we're interested in, certain sectors. Many times what a family office will invest in is the sector that they know. Mm-hmm. So, for example, we have an agriculture client that, will invest in primarily, food and agriculture type investments. The one commonality that you'll find among many family offices is that they'll all invest in some form of real estate. And the reason for that is that you can get, better than bank returns. There's a lot of hedge, capability implied, inflation hedge, capability and safety implied in, certain types of real estate investments. So it's like basically, most family offices will have some sort of real estate portfolio. But mm-hmm. they're also investing in many areas, from venture capital to, energy investing to, I mean, they're all over the board. So it's a big mistake to just assume, family offices are all real estate. They're really not. They're in many, many different sectors. We've seen family offices that invest, for example, in Broadway productions, which is crazy. Right? I have no idea how you do that, but or handicap a good production from a bad one. But there are families that do it. There are families that invest in biotech, and there are family offices actually emerging in your neck of the woods, just a bit south in San Diego, that are all investing in technology venture. These are the guys backing, getting in on the unicorns and so on and so forth. So, there's a lot of varied investment. So there is a thesis. Now, as a multifamily office manager, we try to provide a level of investment discipline and thesis to the families that are less structured in that 30 to 250 million range. We have some larger clients as well that happen to be very structured, and I can explain, some of the sort of interaction that takes place there. But we approach it from a thesis, and our thesis, as I mentioned, we invest in 5 areas. And if you look at those areas, they tend to be very asset heavy. And so asset heavy, and I would say defensive, in terms of some of the, let's say, technology changes that we anticipate taking place and other changes that we anticipate taking place. So by investing in heavy infrastructure, energy, food, those types of areas, we see, ability to put together a sort of all-weather portfolio that will perform in many different economic scenarios. And we always like to say that origination is the key to successful investment returns. If you're let's just hypothetically, it's basic math, but hypothetically, if you're looking at let's say the food sector, and there's 500 deals taking place in that sector, a professional PE firm will see at least 60% of that activity, right? Because they're on all the lists, they're perusing data, they're going to all of the auctions, and so they're going to see at least 60% of that, and so they can cherry pick from a larger audience. Many family offices feel like they're seeing significant deal flow because they get pounded with everything, but they're not seeing as a percentage a large percentage of the activity in a sector. Typically, they're seeing 5 to 10%. So, if you're seeing only 5 to 10% of the, let's say, M&A activity in the food sector, you're really not, being given a chance to participate in the top level deals. We basically are a data-driven group. We have access to a very significant amount of deal flow in the sectors that we cover. Our reputation is that we find stuff that most people haven't seen. And that's because we're not going to auctions. We're not, taking in broker-dealer deal flow. We're basically going straight into, chambers of commerce. We're by investing in particular industries, we start to get intel as to what's happening in those industries. We like to get to the companies when an event is about to happen before the market knows that it's going to happen. And that way we can get in. Usually if there's some urgency, we can get in, we can make an investment, whether that's a debt or equity investment. We can negotiate it directly with the company, get to understand the company, and not have, the critical data that we need to make a, wise investment decision filtered through, third parties. So we really like to get in direct. And that's what we try to do for our family offices.
So then you also argue in the article that, and I quote, family offices are Nirvana for the MicroCap CEO looking for an anchor investor, end quote. Why?
Well, that's a great question, Bobby. And, most of the microcap companies that I see are, look, they're capital starved. They have big business plans. They have voracious appetites for capital, and they're generally relying on sale of equity, to raise the bulk of that capital. Those equity rounds end up being, dilutive to, the earlier investors, and then when they go into the debt markets, they're kind of pushed into, I call it the BDC plus market, where, there's all sorts of bells and whistles added on that, can also be dilutive. ATMs and a lot of these types of investments. And I think I wrote an article a couple of years ago in your magazine that highlighted, several issues and the impact of, taking on dilutive capital. But many CEOs and boards of microcap companies aren't left with much of a choice. Now, with the family offices, if you have a microcap company, let's say an energy company, just as an example, that has a solid geology report, and you've just struggled in terms of getting capital in. You go into family offices that happen to invest in that sector, of which there are many. Have a quality discussion, an honest and open discussion. Talk about your plans, talk about your management teams, talk about the strengths and weaknesses very candidly, right, of what's going on with your business. And if you get a family office on board, that is long-term capital. They can structure deals that are non-dilutive capital, right? They're not a hedge fund with a 3-year horizon or, XYZ hurdle rate that they have to hit. These guys will go in and basically invest and be your partner for the long term. And we always emphasize that just because a company is a public company in the microcap sector, it doesn't mean that everything has to be, a security issuance with registration rights and future dilution windows that always seem to create some sort of overhang on the common, stock investors that basically were the lifeblood of the company in its early stages. There are many structures where, if an asset is, let's say a significant asset is going to require a lot of capital, deals can be structured at the subsidiary level with family offices. And they have the ability to, navigate through those waters and structure deals that are very smart, that are non-dilutive, low-cost sources of capital for public company, management teams. And for that reason, I say it's Nirvana. It's high-quality capital that's well worth the extra effort that it takes to get.
Mm-hmm. So, Karl, what then experience has guided your microcap investing thesis? Like when you're going in and you're looking at a company for potential investment for your one of the family offices, what experience do you think back to as like, oh yeah, I remember that. Like, so, what do you have one of those?
Yeah. We've had, look, 31 years of involvement in investing. Believe me, I've had very significant successes, and I've also had some pretty significant failures. Anyone who's afraid to look at the failure is a great opportunity to learn. So we've become very conservative in terms of how we go in, and since 2007, we've really had an approach of sort of what we call cash flow engines. We invest in sectors where we're not taking a lot of execution risk. So in food and agriculture, energy, you can really boil down a company's ability to perform to some very understandable components. And so when we look at a transaction, and I'll gravitate to energy again because it's never easy, but it's very understandable. You cannot fix geology, right? So we'll go in and make sure that if we're looking at a PV10, that PV10 is done by a top engineering firm like a Netherlands Sewell or somebody on that level, right? And that's not enough. It's a good start, but it's not enough. So we'll look at a PV10 value, which is basically the future projected cash flow of a deal and calculated on a net present value basis, and that's a good start, right? We'll then look at other factors. We don't like to take commodity risk, so we'll look at a situation where when that cash flow is developed, we can hedge. We'll typically do a deal where we're hedging 5 years. And we'll try to get in the deal on a pricing where we can at least have principal return in 3 years. So, that's very much our approach. And then we get to management. What have the management done before? Very critical. We don't want anyone learning on our dime. So, we look for management teams that have had experience within the company size of the company that we're investing in. We've seen scenarios over the years where you get management teams that have come out of the majors, right? Where, they've had, extensive budgets and, so on. Operating in a small company environment or a microcap environment can be very, very different. So we look for, people that have executed in that type of environment before. So, show me somebody that's had, $100 million PV10, in a microcap and has successfully converted that, created a responsible capital structure for the investors. And, that's the type of, company that, we would look to get involved in, in the future.
Mm-hmm. So usually I ask in this, my last question is, advice for new microcap investors, but I'm going to alter this one a little bit in the sense that, what advice do you have for potentially new family offices or high net worth investors that might be looking to start a family office? What advice do you have for them?
Well, first and foremost, origination is expensive, and it's a significant. You need a significant team to basically make sure that you're seeing that 60% plus of deal flow in a sector. Arrive at a thesis. If your thesis is basic commodity investing, make sure that you're seeing the sort of 50-60% plus deal flow in a sector. Now, how do you do that? It's a little bit self-serving, but basically go to a good multi-family office platform that essentially already has that infrastructure in place, because it can take years to build. And if you just start investing in random deals, you're going to get random returns. So by having that origination platform in place, that adds a significant check in terms of ability to make sure you're seeing quality deal flow with quality characteristics, quality management teams, et cetera. Secondly is to have the infrastructure in place to manage those deals. Taking on even 2 or 3 investments for I'm talking significant investments of 25 million plus for a family office can be time consuming, and many families struggle with that, and some fail because of ability to really stay on top of their investments. Steady board presence. Look for companies that have tremendous transparency, that allow you to get a full understanding of the company beyond just the pitch book and the basic information that's in a data room. Try to get very close to the companies and understand what their critical success factors are. Most of the time, and this is the advantage for family offices, most of the time in the microcap sector, its ability to have access to capital at the right time. So, origination is a very, very important component for new families that are considering getting into the space.
And Karl, where can my audience go and find more information about you and PPMT Capital?
We have a website at www.ppmtcapital.com.
Karl, thank you so much for joining me today. It was a pleasure, and I'll be putting a link to your article in the description of this interview. So thank you again for joining me today.
Okay, great. Thank you very much.
Thank you. Thank you all for tuning into the Planet MicroCap podcast, and thank you, Karl, again for coming on to the program. You can access the podcast by going on to stocknewsnow.com under podcast, go to podbean.com and search Planet MicroCap Podcast, or on iTunes and search Planet MicroCap Podcast. Stay tuned for the next Planet MicroCap Podcast, where we'll have our next guest to discuss all things microcap. If you have any questions or comments about the podcast, please send an email to info@snnwire.com. I'd love to hear from all of you. This podcast has been brought to you by SNN Incorporated, publishers of StockNewsNow.com, the official microcap news source, and the MicroCap Review Magazine. I'm your host, Robert Kraft, and thank you again for joining me on the Planet MicroCap podcast. Have a great week, everyone.